Jeff, you were just with Tracy and Joe in the studio, and you told them the super cycle is just beginning. Does that mean that the oil price is going to break out of this range to the upside, even though there's so much supply, apparently?
I like how you say apparently a lot of supply. I like to say, show me the glut. At this point right now, the high frequency data, the last week we showed, substantial draws. They've been telling this oil supply glut story for 18 months now, and it still has not materialized. And whether it's you're looking at the forward curves, and they go, oh, well, it's sitting at oil at sea. Well, a lot of that oil at sea is sanctioned oil that can't be touched. And if you're having to scrape the data to find evidence of this oil supply glut, it's not an oil supply glut. These things hit you over the head like a sledgehammer. I think at this point right now, you had a big short in the market coming at the end of last year. In fact, it got up to 230 million barrels, bigger than the oil supply glut. So this apparently, in expectations of a glut, has had a bigger impact on the market than an actual glut. And now we come into this year, you got risk around Iran, the geopolitical risk, and now we're seeing the unwind of that big short. But I think the key point here is fundamentally, we still have not seen anything other than a cyclical weak patch that we saw, towards the end of last year as that OPEC increase in supply hit the market. But I think the main message I want to leave you with is these markets, whether we're talking oil, metals, all of the old economy is substantially underinvested. You look at oil, the last of the non-OPEC supply surge comes through this year. There's really nothing behind it. We have not seen investment in refineries, copper mines, the rest of it. And that's really at the core of our call for a commodity super cycle. Combine that with policy-driven demand that will likely continue to keep these markets tight. I think there's a lot of upside here.
Now, the one the question I have, at least in the short term, Jeff, is about Donald Trump. I mean, he seems to measure his success on how low the prices at the pump are. And so it would strike me that, if there's this much sanctioned oil on the water, he's going to get the sanctions off to get that oil here quickly if we see the price start to creep higher.
Well, I mean, you look at the draws that you had last week. Clearly, there's the ability to accommodate it. But I think there's a bigger point here. Is yes, let's say you have a little bit of a glut out there. Let's say it's 50, 100 million barrels that could be brought in if you got rid of the sanctions immediately, which I think would be really difficult to do, and nobody expects that. It's not going to solve the longer term problem. And what we're seeing in the metals markets, you've got copper, it's sold off last week, but we're back above $13,000 a ton again, which is an indication that this market is structurally short. All of these markets are structurally short. They're global in nature. And the fact of the matter is, with all the geopolitical uncertainty, there's a high incentive for consumers around the world to hoard commodities. President Trump just announced his vault. The vault is hoarding metal for the United States. China's been hoarding oil because they're structurally short oil. India, Europe, also structurally short oil. So I think these all got to be factored in, that you have these geopolitical risks that are incentivizing hoarding. At the same time, we haven't invested. And we called this the revenge of the old economy. And it's a rotation out of the new economy, tech or asset light, into the old economy, which is asset heavy. Mm-hmm. Now, to give you some numbers, NASDAQ is down 9%, metals and mining is up 25%, and energy, despite the oil glut, is up 22%. So that swing is over 30%.
Right. Well, Jeff, it's interesting. I'm glad you sort of couch this in what's going on with the broader commodity space, because it does feel like, especially from the start of 2026, that there has been some sort of catalyst, and, you can draw some sort of common denominator there with what's going on across these different commodities into what's going on with the geopolitical landscape. But I wonder how that shifted the investor base. When you think about who's buying gold, when you think about who's buying oil, it's not just commodity investors, people who know the space in and out. I feel like, for better or worse, whatever you want to call them, tourists have also started entering these markets in a big way as well.
But you need an enormous number of tourists. We got to be rotating capital out of the new economy into the old economy. Let's take the hyperscalers. They're investing, hundreds of billions of dollars into data centers that are going to consume power. How do you produce that power? Is with commodities. You need the copper to produce the grid, the transformers. You need natural gas to produce the power in the United States, and then you need other natural resources elsewhere in the world. So that investment today is putting pull on the old economy or asset-heavy sector. In other words, you have these hyperscalers that used to be asset-light, infinitely scalable software-based type companies that are now doing asset-heavy businesses. That gets you a lower multiple. Also, you have the fact that they're running into supply constraints, and that's going to put a pull. So we got to take that capital out of that sector and start investing in asset-heavy industries and commodities. And so you call them tourists, but we need, in fact, I like to point out, we haven't seen tourists, as you say, in these markets really in scale since the period of 2002 to 2012, 2013.
Right.
2014 was the last time you had real investment in this space.
Well, Jeff, we only have a minute left, but that's actually exactly where I want to go. The fact that, you think about what we're seeing right now, this new profile of investor coming in. I won't call them tourists anymore, but can you draw a parallel between any other periods of times, given your experience covering commodities? What time period does this most remind you of?
2001, 2, 3, and 4. That was the end of the dot-com boom. We saw a massive, that's when we coined the term, the revenge of the gold economy. It swung out of the new economy, which was the internet, and into the old economy. I saw a great comment earlier today. You look at the Super Bowl ads in Super Bowl 2000, they're all, internet-based, and it was all about, pets.com. 10 months later, that rotation happened very violently. What was it last night in the Super Bowl? It was all about AI. We'll see how long this lasts, but I think the key point this time around, those internet guys weren't putting steel in the ground. These AI guys this time around, they're putting steel in the ground, and they're going to hit those constraints, and we'll likely see that rotation.